Let me tell you something that will probably shock you. If I were starting over today with just $100,000 and I needed to generate $50,000 per year in income, I could do it. Not in 10 years, not in 5 years. I could do it within 12 to 24 months. And the method I would use is completely different from what most people expect from someone like me. You see, when people think about my investment philosophy, they imagine buying great companies and holding them forever. They picture Coca-Cola and American Express and Apple sitting in a portfolio collecting dividends while the years roll by. And yes, that approach has made me one of the wealthiest people in the world. But here is what nobody talks about. That approach works brilliantly when you have billions of dollars. When you have vast sums of capital, your options become limited. You cannot make meaningful investments in small opportunities because they simply do not move the needle. A $50 million profit on a small position does not change anything for someone managing hundreds of billions. But when you have $100,000, everything changes. Your size becomes your greatest advantage. Doors that are closed to me today would swing wide open. Opportunities that I cannot touch would be sitting there waiting for you to grab them. And the strategies I would employ would generate returns that would seem almost impossible to someone watching from the outside. Today, I am going to share exactly how I would transform $100,000 into $50,000 of annual income. This is not theory. This is not wishful thinking. This is the playbook I would actually follow if I woke up tomorrow with nothing but a six-figure sum and the knowledge I have accumulated over more than 7 decades of investing. And I promise you, by the end of this, you will understand that generating 50% returns annually is not only possible, but almost inevitable when you know where to look and have the discipline to act. Let me start by taking you back to 1951. I was 20 years old. I had just graduated from Columbia, where I studied under Benjamin Graham, the father of value investing. I had saved up about $10,000 from various ventures. I had started as a kid, delivering newspapers, selling golf balls, running pinball machine businesses. That $10,000 was my entire net worth. And I knew that if I was going to build real wealth, I needed to generate exceptional returns on that small capital base. Now, here is what most people do not understand about small capital. When you have a limited amount of money, you can invest in opportunities that are completely inaccessible to large investors. You can buy tiny companies. You can take positions that would not even register for institutional investors. You can move in and out of situations without moving the market. And you can find inefficiencies that the big players simply cannot exploit. In 1951, I discovered a company called Western Insurance Securities. I found it by doing something that seemed crazy to most people. I read through Moody's manuals, thousands of pages of financial data on thousands of companies, looking for situations where the numbers did not make sense, where a company was trading for less than it was obviously worth. Western Insurance Securities was trading at about $3 per share. But when I dug into the numbers, I realized the company had investments worth around $20 per share. And the market was essentially giving away this company for free and then some. I bought as many shares as I could afford. Within a year, the stock had tripled. That kind of return, over 100% in 12 months, seems impossible when you manage billions. But when you manage thousands, it is not only possible, it happens regularly if you know where to look. And that experience taught me something that has stayed with me for over 70 years. The size of your capital determines the size of your opportunity set. When you have $100,000, your opportunity set is enormous. The market is full of inefficiencies waiting to be exploited, small companies that Wall Street ignores, special situations that institutional investors cannot participate in, arbitrage opportunities that require speed and flexibility. These opportunities exist today just as they existed in 1951. The playing field has changed, but the game remains the same. Now, let me be very specific about the strategy I would use to turn $100,000 into $50,000 of annual income. The first thing I would do is forget everything you have heard about diversification. When you have limited capital and you need to generate exceptional returns, diversification is not your friend. Diversification is protection against ignorance. It makes sense when you do not know what you are doing, but when you have identified genuine opportunities with exceptional risk-reward ratios, concentration is how you build wealth quickly. I would aim to hold no more than 5 to 8 positions at any given time. And within those positions, I would have 1 or 2 that I consider my best ideas, my highest conviction bets, where I would concentrate 30 to 40% of my capital. This is not reckless. This is calculated when you have done the work, when you understand the situation deeply, when you can see that the market is mispricing an asset. Concentrating your capital is the rational thing to do. The second thing I would do is focus exclusively on special situations. What do I mean by special situations? I am talking about corporate events that create temporary mispricings, spin-offs, merger arbitrage, liquidations, bankruptcy reorganizations, rights offerings. These situations create opportunities because they force selling by institutions that have mandates preventing them from holding certain securities. Index funds cannot hold spin-offs until they are added to an index. Many mutual funds cannot hold securities below a certain market cap. Some institutions are prohibited from holding companies going through bankruptcy. When forced selling happens, prices decouple from value, and that is where the money is made. Let me give you a specific example of how this works. When a large company spins off a small subsidiary, something predictable happens. The parent company shareholders receive shares of the new spin-off company. But here is the thing. Most of those shareholders do not want the spin-off shares. They bought the parent company for a reason. The spin-off is often in a different industry, a different size, a different risk profile. So what do? They sell. And they sell indiscriminately. They do not analyze the spin-off. They do not calculate its intrinsic value. They just dump the shares because they want to own what they originally bought. This creates a temporary but significant dislocation between price and value.
The spin-off trades at a depressed price for weeks or sometimes months, while forced selling works its way through the system.
And then, once the selling pressure subsides, the stock price typically moves toward its intrinsic value. Studies have shown that spin-offs outperform the market by an average of 10% in their first year. Some of the best spin-offs have generated returns of 50, 100, even 200% within 18 months. This is not speculation. This is a documented phenomenon that occurs over and over again. And it happens because the market is temporarily irrational, creating an opportunity for those who are paying attention. Now, let me explain exactly how I would execute this strategy with $100,000. I would start every day by screening for special situations. Not stock charts, not momentum indicators, not what is trending on social media. I would look for corporate events that create forced selling. SEC filings are public. You can see when spin-offs are announced. You can see when mergers are proposed. You can see when companies enter bankruptcy and propose reorganization plans. This information is available to anyone who takes the time to look for it. Once I identified a promising situation, I would do deep research. I would read every filing, every proxy statement, every analyst report. I would understand the business, its competitive position, its management, its financial structure. I would calculate what I believed the company was worth and compare it to where it was trading. And if I found a significant gap between price and value, if I found a situation where I was paying 50 or 60 cents for something worth $1, I would buy aggressively. Let me walk you through a hypothetical example using real market dynamics. Imagine a large technology company announces it is spinning off its enterprise software division. The parent company has a market cap of $100 billion. The spinoff will have revenues of $3 billion and is expected to trade at a market cap of about $15 billion based on comparable companies. But when the spinoff actually begins trading, something happens. The parent company shareholders start dumping shares. Index funds that cannot hold the spinoff sell. Momentum funds that only want the parent company sell. Within the first few weeks, the spinoff drops 30% below where analysts expected it to trade. Now it has a market cap of about $10 billion instead of $15 billion. The business has not changed. The revenues are still $3 billion. The profit margins are still the same. The competitive position is still the same. But the prices drop because of technical selling pressure, not fundamental problems. This is the opportunity. If you buy at 10 billion when the company is worth 15 billion, you have a 50% upside to fair value. And often these spinoffs do not just return to fair value, they exceed it because management teams at newly independent companies are highly motivated. They have stock options that vest based on performance. They have something to prove. And without the bureaucracy of the parent company, they can move faster and more aggressively. I actually made one of my best early investments through exactly this type of situation. It was a company that had been orphaned by the market. Nobody was covering it. Nobody was paying attention. It was too small for institutions and too boring for individual investors. But the fundamentals were exceptional. The company was generating significant cash flow, trading at a single-digit earnings multiple, and had a dominant position in a niche industry. I bought a substantial position. Over the next 3 years, the stock quintupled. That single investment generated more returns than most people's entire portfolios. And it happened because I was willing to look where others were not looking. Now, let me address something important. When I talk about generating $50,000 of annual income from $100,000, I am not talking about dividend income, at least not initially. Dividend-focused investing is a wonderful strategy for preserving wealth and generating income from a large portfolio, but it is not the fastest path to building that large portfolio in the first place. Think about the math. Most dividend-paying stocks yield between 2 and 4%. Even the highest quality dividend stocks rarely yield more than 5 or 6% consistently. At a 4% yield, $100,000 generates $4,000 per year. That is nowhere near $50,000. To generate $50,000 in dividend income from a 4% yield, you would need $1.25 million. So the goal is not to invest $100,000 for dividend income. The goal is to invest $100,000 for capital appreciation, grow it rapidly, and then transition to income-producing investments once you have built a larger capital base. Here is the math that makes $50,000 of annual income achievable. If you can generate 50% returns annually on $100,000, after 1 year you have $150,000. After 2 years you have $225,000. After 3 years you have $337,000. After 4 years you have $506,000. After 5 years you have $759,000. Now, at $759,000, if you transition to a 6.5% dividend yield strategy, you generate about $49,000 per year. That is essentially your $50,000 annual income target. And this is not even accounting for the possibility of reinvesting some of those gains along the way or continuing the high growth strategy for a 6th or 7th year. The math works. The question is whether 50% annual returns are achievable. And my answer, based on 70 years of experience, is absolutely yes. For someone with $100,000, 50% annual returns are not only achievable, they are almost conservative compared to what is possible. When I was running my partnership in the 1950s and 60s, I was generating returns of over 30% annually on average. And that was with millions of dollars, not 100,000. With smaller capital, the opportunities multiply. I have said many times that if I were managing $1 million today, I would guarantee 50% returns. I actually said that publicly, and I meant it. The reason is simple. With small capital, you can invest in situations that are invisible to the institutions that dominate the market. You can buy stocks that trade for a few $100,000 per day without moving the price. You can take positions in micro-cap companies that no analyst covers. You can exploit inefficiencies that exist precisely because the big players cannot participate. Let me give you another specific strategy that works exceptionally well with small capital. Merger arbitrage. When one company announces it is acquiring another company, there is typically a spread between the current stock price and the announced acquisition price. This spread exists because there is uncertainty about whether the deal will close. Regulatory approval might be required. Shareholders might vote against it. Financing might fall through. This uncertainty creates an opportunity. If you can analyze the likelihood of deal completion and find situations where the market is overpricing the risk, you can capture returns with relatively low risk. Here is how it works mathematically. Imagine Company A announces it is acquiring Company B for $50 per share in cash. Company B is currently trading at $47 because the market is uncertain about deal completion. The deal is expected to close in 6 months. If you buy Company B at $47 and the deal closes at $50, you make $3 per share. That is a 6.4% return in 6 months, or about 12.8% annualized. Now that might not sound like 50% returns, but here is where it gets interesting. Merger arbitrage situations often allow you to use leverage safely because the risk is bounded, the maximum you can lose, the timing, and you can diversify across multiple deals to reduce the risk of any single deal failing. Some of the most successful merger arbitrage investors have generated 20 to 30% annual returns with remarkably consistent performance. And when you combine merger arbitrage with spin-offs and other special situations, 50% returns become very achievable. I want to share something about the mindset required to execute this strategy. Most people cannot do this, not because they lack the intelligence, not because they lack the resources, but because they lack the discipline and the patience. Let me explain. When you are investing in special situations, you are often buying when everyone else is selling. You are buying spin-offs that the market is dumping. You are buying stocks that have dropped 30 or 40% due to forced selling. You are swimming against the current of market sentiment. This is psychologically difficult. Your brain is wired to seek safety in numbers. When everyone is selling, every instinct tells you to sell too. When a stock is dropping, every emotion screams at you to get out before it drops further. But special situation investing requires you to ignore these instincts. It requires you to trust your analysis even when the market is screaming that you are wrong. It requires you to buy more when prices drop if your thesis remains intact. This is not natural. This is learned behavior. And most people never learn it. I remember early in my career, I found a company trading at a massive discount to its liquidation value. The company was being wound down. The assets were being sold, and the market was pricing the stock as if the assets were worth far less than they actually were. I bought a significant position. Then the stock dropped another 20%. My partners were nervous. They wanted to know why I was not selling. I explained that nothing had changed about the fundamentals. The assets were still there. The liquidation was proceeding. The only thing that had changed was the market price. And a lower market price meant a better opportunity, not a worse one. I bought more. 3 months later, the liquidation was completed, and we received proceeds that were 70% higher than our average purchase price. That investment generated a 50% return in less than 6 months. But it only happened because I had the discipline to ignore market sentiment and trust my analysis. Now let me talk about something that most people completely overlook when they think about generating income from investments. Tax efficiency. If you are trying to turn $100,000 into $50,000 of annual income, the taxes you pay can make an enormous difference in how quickly you achieve your goal. Short-term capital gains, which apply to investments held less than 1 year, are taxed at ordinary income rates. Depending on your tax bracket, that could be 22, 24, 32, or even 37%. Long-term capital gains, which apply to investments held more than 1 year, are taxed at significantly lower rates, usually 15 or 20%. This difference matters enormously when you are compounding capital. If you generate a 50% return but pay 37% in taxes, your after-tax return is only 31.5%. But if you generate a 50% return and pay only 20% in taxes, your after-tax return is 40%. Over multiple years, this difference compounds dramatically. So one key to executing this strategy effectively is to hold positions for at least 1 year whenever possible. This does not mean you ignore short-term opportunities. Some special situations play out in weeks or months, and the returns justify the higher tax rate. But when possible, structuring your investments to qualify for long-term capital gains treatment significantly accelerates your path to $50,000 of annual income. Let me share another strategy that works exceptionally well for small investors: micro-cap investing. Microcap companies are those with market capitalizations below $300 million. These companies are too small for most institutional investors. A large mutual fund cannot buy a meaningful position in a $50 million company without moving the stock price dramatically and then struggling to exit when they want to sell. This creates a structural inefficiency. Microcap stocks are often under-researched and undervalued simply because the big players cannot participate. And this is where small investors have an enormous advantage. With $100,000, you can build a meaningful position in a microcap company without any market impact. You can buy over days or weeks at prevailing prices. And if your analysis is correct, you can ride the stock higher as value is eventually recognized. Some of my best early investments were in companies that no one else was looking at. Companies that were too small, too obscure, too boring for the sophisticated investors who dominated the market. These companies often traded at absurdly low valuations simply because there was no one paying attention. And when value was eventually recognized, often through an acquisition or a significant improvement in business performance, the returns were exceptional. I want to be clear about something important. What I am describing requires work, real work. You cannot generate 50% returns by checking your phone occasionally and buying whatever stock is trending on social media. You need to read financial statements. You need to understand businesses. You need to develop frameworks for valuation. You need to screen for opportunities systematically. You need to track corporate events and special situations. This is not passive investing. This is active, engaged, intellectually demanding work. But here is the beautiful thing. The work itself is fascinating. When you start to understand how businesses operate, how value is created, how markets misprice assets, investing becomes endlessly interesting. Every company has a story. Every special situation has unique dynamics. Every investment decision teaches you something new. I've been doing this for over 70 years, and I still wake up excited to read about new situations and analyze new opportunities. Let me also address risk management, because this is crucial when you are pursuing aggressive returns. When you concentrate your portfolio and invest in special situations, you are taking on more risk than a diversified index fund investor. That is the trade-off for higher returns. But risks can be managed intelligently. The first rule is position sizing. No single position should be large enough to devastate your portfolio if it goes to zero. Even my highest conviction ideas rarely exceed 30 or 40% of a portfolio. And I only take those concentrated positions when I have exceptional conviction and a significant margin of safety. The second rule is understanding what you own. I never invest in a situation I do not understand thoroughly. If I cannot explain the business, the opportunity, and the risks in simple terms, I do not invest. This protects me from situations that might look attractive on the surface, but have hidden risks that I have not identified. The third rule is having a thesis and monitoring it. Every investment should have a clear thesis. What is the catalyst that will cause the market to recognize value? What is the timeline? What would have to happen for me to be wrong? If the thesis changes, if the facts that supported your investment no longer hold, you need to be willing to exit even at a loss. Now let me talk about the transition from capital appreciation to income generation. Once you have grown your $100,000 to a larger sum through special situations and aggressive value investing, you can begin transitioning to income-producing investments. There are several approaches that work well. The first approach is dividend growth investing. This involves buying companies with a history of increasing their dividends annually. Companies like the ones in the Dividend Aristocrats Index, which have raised dividends for at least 25 consecutive years, these companies provide growing income streams that help protect against inflation. At a starting yield of 3 to 4%, with dividend growth of 7 to 10% annually, your income doubles roughly every 7 to 10 years. The second approach is real estate investment trusts, commonly called REITs. These are companies that own and operate real estate and are required by law to distribute at least 90% of their taxable income to shareholders. REITs often yield 5 to 8%, providing higher immediate income than traditional dividend stocks. The third approach is covered call strategies. If you own stocks, you can sell call options against your positions to generate additional income. This caps your upside but provides immediate cash flow. Skilled options traders can generate an additional 3 to 5% annually through covered calls. The fourth approach is Preferred stocks and bonds. Once you have built a larger capital base, allocating a portion to preferred stocks and high-quality bonds can provide stable income with lower volatility than common stocks. The key insight is that the strategy changes as your capital grows. When you have $100,000, you need aggressive growth. You need to exploit the inefficiencies available to small investors. You need to concentrate and take calculated risks. But as your capital grows to 500,000, 1 million, or beyond, you can gradually transition to a more income-focused approach. The goal is to reach a point where your capital is large enough that conservative investments can generate your target income. And once you reach that point, you can sleep well at night knowing that your income is secure regardless of short-term market fluctuations. I want to address something that holds many people back from pursuing this strategy. Fear. Fear of losing money. Fear of making mistakes. Fear of looking foolish. I understand these fears. Everyone who invests experiences them, but fear is the enemy of wealth creation. Let me tell you something about my own experience with fear. In 1974, the stock market crashed. The Dow Jones Industrial Average dropped 45% from its peak. Investors were terrified. Headlines predicted economic collapse. People were selling everything. And I was buying, I call it the best time to buy stocks in decades. I invested heavily when everyone else was fleeing. That decision was one of the best I ever made. The investments I made during that period of fear generated extraordinary returns as the market recovered. Fear causes investors to sell at the bottom and buy at the top. Fear causes investors to avoid opportunities that seem too good to be true. Fear causes investors to stay in cash while inflation erodes their purchasing power. The antidote to fear is preparation. When you have done the work, when you understand what you own, when you have calculated intrinsic value and determined your margin of safety, you can act with confidence even when the market is panicking. You can buy when others are selling because you know something they do not. You know what your investments are actually worth. Let me share a specific framework for implementing this strategy over the first year. Month 1 and 2, education and preparation. Read everything you can about special situations, investing. Study past spin-offs and how they performed. Learn how to read SEC filings. Develop a screening process for identifying opportunities. Do not rush to invest. Take time to build your knowledge base. Month 3 and 4, paper trading in small positions. Start tracking special situations in real time. Paper trade a few positions to test your analysis. Make a few small investments to experience the emotional reality of putting money at risk. Learn from mistakes while the stakes are low. Month 5 through 12, full implementation. Begin taking meaningful positions in your highest conviction ideas. Build a portfolio of 5 to 8 special situations. Monitor your investments closely. Adjust position sizes based on how theses develop. Reinvest profits into new opportunities as they arise. If you execute this framework with discipline and patience, achieving 50% returns in your first full year is absolutely achievable. Some years will be better than 50%, some years might be worse. The key is consistency over time. Even if you achieve only 40% returns instead of 50%, you will still reach your $50,000 income goal within 6 to 7 years. The math still works. The strategy still succeeds. I want to leave you with one final thought. The strategy I've described is not easy. It requires work. It requires discipline. It requires the emotional fortitude to act independently when the crowd is moving the other way. But here is what I know from 70 years of experience. The rewards are worth it. Financial independence changes everything. When you have $50,000 of annual income from your investments, you have freedom. Freedom to pursue work that matters to you rather than work that pays the bills. Freedom to spend time with family without constant financial stress. Freedom to weather economic downturns without fear. Freedom to give generously to causes you care about. That freedom is achievable. It is achievable for someone starting with $100,000. It is achievable within 5 to 7 years. It is achievable through strategies that any intelligent person can learn and implement. The question is not whether this is possible. The question is whether you are willing to do the work. Now, some of you might be skeptical. You might be thinking that what worked in the 1950s or 60s cannot work today. Markets are more efficient. Information travels faster. Computers and algorithms dominate trading. And there is some truth to these concerns. Markets have changed. Competition has intensified. But special situations still exist. Spin-offs still happen. Merger arbitrage spreads still exist. Microcap inefficiencies still persist. The opportunities have not disappeared. They have just moved to corners of the market where most investors are not looking. And that is actually good news for someone with $100,000, because the big institutional investors, the hedge funds with billions of dollars, the mutual funds with massive assets under management, they cannot operate in these corners. The opportunities are too small for them, but they are perfect for you. Think about what has happened in just the past few years. Dozens of major spin-offs, hundreds of merger announcements, thousands of microcap companies trading at significant discounts to intrinsic value. The opportunity set is enormous. What is missing is not opportunity. What is missing is investors willing to do the work to find and exploit these opportunities. Most individual investors want easy answers. They want someone to tell them which stock to buy. They want a hot tip that will make them rich overnight. They are not willing to read through SEC filings. They are not willing to analyze businesses deeply. They are not willing to think independently. And that is exactly why the opportunities persist. The inefficiencies exist because most people are too lazy or too scared to exploit them. I have spent my career taking advantage of other people's laziness and fear. I have bought when others sold out of panic. I have invested in situations others ignored out of laziness. I have concentrated when others diversified out of fear. And the results speak for themselves, not through luck, not through timing, but through disciplined application of sound principles to available opportunities. You can do the same. With $100,000 and the willingness to work, you can generate returns that most people believe are impossible. You can build the capital base necessary to generate $50,000 in annual income. You can achieve financial freedom within a reasonable time frame. The path I have described is not the only path. There are other strategies that can work. Real estate, starting a business, building valuable skills and commanding high salaries. But if you want to build wealth through investing, if you want to let capital work for you, if you want to achieve returns that compound over time into life-changing sums, then special situations investing is the path I would take. It is the path I took when I was starting out, and it is the path I would take again if I were starting over today with $100,000 and the need to generate $50,000 in annual income. The math works. The opportunities exist. The question is whether you will do what it takes to make it happen. Let me go deeper into some specific techniques that will help you execute this strategy successfully. The first technique is what I call scuttlebutt investing. This was popularized by Philip Fisher, one of the great investors of the 20th century. Scuttlebutt investing means talking to everyone involved with the company before you invest. Talk to customers, talk to suppliers, talk to competitors, talk to former employees, talk to industry experts. These conversations will give you insights that no financial statement can provide. You will learn about customer satisfaction. You will learn about competitive dynamics. You will learn about management quality. You will learn about industry trends. Most investors rely exclusively on public filings and analyst reports, but the real insights come from talking to people in the industry. When I was researching insurance companies early in my career, I did not just read annual reports. I called insurance agents. I talked to people who filed claims. I learned how companies actually operated in the real world, not just how they presented themselves to investors. This ground-level research gave me conviction that I could not have obtained any other way. The second technique is understanding the difference between price and value. This seems obvious, but most investors confuse the two constantly. Price is what the market says a company is worth today. Value is what the company is actually worth based on its future cash flows. Price and value can differ dramatically, especially in special situations. When a spin-off is being dumped by forced sellers, the price drops, but the value remains unchanged. When a merger is announced and spreads widen due to market uncertainty, the price of the target company drops, but the value, the eventual acquisition price, remains unchanged. Your job as an investor is to determine value independently and then compare it to price. When price is significantly below value, you buy. When price exceeds value, you sell or avoid. This sounds simple, but requires discipline. You must be willing to disagree with the market. You must trust your analysis over the collective judgment of millions of other investors. Most people cannot do this. They assume the market knows better. They assume that if a stock is trading at a certain price, that price must be right. But the market is not always right. The market is just the sum of everyone's opinions, weighted by how much money they are willing to put behind those opinions. And when forced selling or panic or ignorance distorts those opinions, the market can be spectacularly wrong. Let me tell you about another investment that illustrates these principles. There was a company called Sanborn Map in the late 1950s. This company made detailed maps of American cities that were used by fire insurance companies. The business was declining slowly as new technologies emerged. But here is what the market was missing. Sanborn Map had an investment portfolio that was worth significantly more than its entire market capitalization. Let me say that again. The investment portfolio alone was worth more than what the market was valuing the entire company at. That meant the market was assigning negative value to the operating business. You were essentially getting paid to take ownership of a profitable, cash-generating business. This was absurd. I bought a controlling stake in Sanborn Map. I convinced the board to distribute the investment portfolio to shareholders, and we walked away with an enormous profit. That investment worked because I was willing to dig into the details, see something the market was missing, and act on it with conviction. The same kinds of opportunities exist today. They just require the work to find them. Let me discuss another critical aspect of this strategy. Information sources. Where do you find these special situations? Let me give you a comprehensive list. First, SEC filings. Every public company in America files regular reports with the Securities and Exchange Commission. These filings are free and publicly available. You can search for spin-offs, mergers, tender offers, and other corporate events. The SEC website has a search function that lets you filter by filing type. Learn to use it. Second, specialized newsletters and websites. There are services that track spin-offs, merger, arbitrage, and other special situations. Some are free. Some charge subscription fees. The paid services can be worthwhile if they save you time and help you identify opportunities you might otherwise miss. Third, trade publications. Every industry has publications that cover news and events. These publications often report on mergers, acquisitions, and other corporate events before they become widely known. Reading industry-specific news can give you an information advantage. Fourth, corporate investor relations. Most companies have investor relations departments that will answer questions from shareholders and potential shareholders. If you have questions about a company's strategy, financials, or upcoming events, call them. You will often get useful information that is not readily available elsewhere. Fifth, proxy statements. When companies propose mergers, spin-offs, or other significant transactions, they file proxy statements with detailed information about the transaction. These documents can be hundreds of pages long, but they contain essential information for evaluating special situations. Read them carefully. Let me also discuss the psychological aspects of special situations, investing in more detail. This type of investing requires contrarian thinking. You are buying when others are selling. You are investing in situations that most people avoid. You are taking positions that might look wrong in the short term. This is emotionally challenging. When you buy a spin-off that everyone is dumping, you will likely see the price drop further in the days and weeks after your purchase. Forced selling often continues for weeks as different institutional investors receive their shares and decide to sell. You must have the conviction to hold through this period. You must understand that the selling is technical, not fundamental. You must trust your analysis of intrinsic value. I have found that keeping a written record helps with this. Before making any investment, I write down my thesis. What is the opportunity? What is my estimate of intrinsic value? What is the catalyst that will cause the market to recognize value? What would have to happen for me to be wrong? Having this written record serves two purposes. First, it forces me to think clearly before investing. If I cannot articulate my thesis in writing, I probably do not understand the situation well enough. Second, it provides a reference point when emotions run high. When a stock drops and I am tempted to sell, I can revisit my original thesis. Has anything changed? Is the opportunity still intact? If so, I hold or buy more. If my thesis is broken, I sell regardless of whether I have a profit or loss. Another psychological challenge is the fear of missing out. When you are focused on special situations, you will often watch other parts of the market rally without participating. Growth stocks might soar, meme stocks might multiply, cryptocurrencies might skyrocket, and you will be sitting in boring spin-offs and merger arbitrage positions that grind out steady returns. This requires discipline. You must remember why you are following this strategy. You are pursuing reliable, repeatable returns that compound over time. You are not trying to hit home runs. You are trying to hit singles and doubles consistently. The investors who chase hot stocks and speculative trends often give back their gains and more when the tide turns. The investors who stick with special situations build wealth steadily through all market conditions. Let me share some common mistakes to avoid when implementing this strategy. The first mistake is inadequate research. Special situations require deep understanding. You need to know why the opportunity exists, what the catalyst for value realization is, and what risks you face. Superficial research leads to poor investment decisions. Take the time to understand each situation thoroughly before committing capital. The second mistake is ignoring liquidity. Some special situations involve very small companies or thinly traded securities. If you cannot exit your position when you need to, you can be trapped in a declining investment. Always consider how you will sell before you buy. Make sure there is adequate trading volume or a clear exit event like a merger closing. The third mistake is overconcentrating too early. I said earlier that concentration is important for generating high returns, but concentration should follow conviction, and conviction should follow research. Do not concentrate in the position until you have done enough work to develop genuine conviction. Start with smaller positions and increase size as your understanding deepens. The fourth mistake is ignoring taxes. As I mentioned earlier, the difference between short-term and long-term capital gains rates is significant. Consider the tax implications of your investment timeline. Sometimes it makes sense to hold a position for an additional few months to qualify for long-term rates. The fifth mistake is failing to adapt. Markets change. Strategies that worked in the past may not work in the future. New regulations, new technologies, and new competitive dynamics can alter the landscape. Stay curious, keep learning. Be willing to adjust your approach as conditions change. Now let me discuss what I call the compounding mindset. This is perhaps the most important concept for turning $100,000 into $50,000 of annual income. Compounding is the process by which investment returns generate additional returns. Your profits earn profits. Your gains compound upon gains. Albert Einstein allegedly called compound interest the eighth wonder of the world. I do not know if he actually said that, but the sentiment is correct. Compounding is extraordinarily powerful over long time periods. At 50% annual returns, your money doubles approximately every 18 months. After 5 years, $100,000 becomes $759,000. After 10 years, it becomes nearly $5.8 million. The numbers seem almost impossible, but that is the mathematics of compounding. Now, sustaining 50% returns for 10 consecutive years is extremely difficult. Even the best investors experience down years. But here is what matters. Even if your returns vary significantly from year to year, the long-term average determines your outcome. If you average 40% returns over 10 years, $100,000 becomes nearly $2.9 million. If you average 30% returns over 10 years, $100,000 becomes nearly $1.4 million. Any of these outcomes puts you in a position to generate $50,000 of annual income from dividends and other income-producing investments. The compounding mindset means thinking in terms of long-term wealth accumulation rather than short-term profits. It means reinvesting gains rather than spending them. It means being patient as the numbers grow slowly at first and then accelerate dramatically. It means understanding that the biggest gains come at the end of the compounding period, not the beginning. Let me illustrate this with a simple example. In year one, 50% returns on $100,000 equals $50,000 of gains. In year five, 50% returns on $506,000 equals $253,000 of gains. In year 10, 50% returns on $5.8 million equals $2.9 million of gains. The returns are the same percentage each year, but the dollar amounts grow dramatically because the base keeps getting larger. This is why starting early is so important. Every year you delay is a year of compounding you lose. It is not the absolute dollars you invest that determine your outcome. It is the time you give those dollars to compound. Let me share another practical consideration. Building your knowledge base. Successful special situations investing requires specific knowledge and skills. You need to understand corporate finance. You need to understand accounting. You need to understand how to read financial statements. You need to understand how different corporate events affect shareholder value. This knowledge can be acquired through books, courses, and practice. Let me recommend some resources. Security Analysis by Benjamin Graham is the foundational text for value investing. The Intelligent Investor, also by Graham, is more accessible and focuses on investment philosophy. You Only Have to Get Rich Once by Joel Greenblatt is an excellent introduction to special situations investing. Margin of Safety by Seth Klarman is a brilliant exploration of value investing principles. These books will give you the theoretical foundation, but theory alone is not enough. You must practice applying these concepts to real situations. Start by paper trading. Track special situations without committing real money. See how your analysis plays out. Learn from your mistakes without losing capital. Then gradually begin investing real money as your skills and confidence develop. I also want to discuss the role of patience in this strategy. Patience is perhaps the most underrated quality in investing. Successful special situations investing requires patience in multiple dimensions. First, patience to wait for the right opportunities. Not every day brings a compelling special situation. Sometimes you need to wait weeks or months for the right opportunities to appear. Do not force investments just because you feel like you should be doing something. Second, patience to let positions play out. Special situations often take time to resolve. Spin-offs take months to find their footing. Merger arbitrage spreads can persist for 6 to 12 months. Value realization can take even longer. Do not get impatient and sell before your thesis has time to work. Third, patience to compound over years. Building significant wealth from $100,000 takes time, even with exceptional returns. You need 5 to 7 years of disciplined investing to reach your goal. This is a long time horizon by modern standards, where people expect instant gratification, but it is actually a remarkably short time to achieve financial independence when you consider that most people work for 40 years without ever achieving it. Let me talk about building conviction and why it matters so much in this type of investing. When you have genuine conviction in an investment, you can act decisively and hold through volatility. When you lack conviction, you second-guess yourself constantly and often sell at exactly the wrong time. Conviction comes from deep understanding. It comes from doing the work to know a situation inside and out. It comes from stress testing your thesis against every possible objection. When I make an investment, I want to understand the business so well that I could run it myself. I want to know the competitors, the customers, the suppliers, the regulatory environment, the economic sensitivities. I want to have thought through every scenario and understand how the investment would perform in each one. This level of preparation gives me conviction. And conviction gives me the ability to act decisively when opportunities arise and hold firmly when prices fluctuate. Most investors never develop this level of conviction because they never do the work required. They buy based on tips or momentum or superficial analysis. Then when prices move against them, they panic because they do not truly understand what they own. Do not be like them. Do the work, develop conviction, and then have the courage to act on it. Let me address the question of diversification more fully because it is so misunderstood. Conventional wisdom says diversification is essential for managing risk. And For most investors, that is probably true.
If you do not have the time or skill to analyze individual investments deeply, diversification protects you from catastrophic losses in any single position.
But for investors pursuing exceptional returns, diversification can be counterproductive. Here is why. Every investment idea you have does not carry equal weight. Some ideas are better than others. Some opportunities are more compelling than others. When you diversify broadly, you are forced to include your mediocre ideas along with your best ideas. This dilutes your returns. Your best ideas might generate 40 or 50% returns. Your mediocre ideas might generate 5 or 10% returns. Average them together across a broadly diversified portfolio and you get market-like returns of 8 to 10%. That is fine for most people, but it will not turn $100,000 into $50,000 of annual income in 5 to 7 years. To achieve exceptional returns, you must concentrate on your best ideas. This means having the discipline to pass on mediocre opportunities, even when you feel like you should be doing something. It means having the conviction to hold large positions in situations you understand deeply. It means accepting more volatility in exchange for higher expected returns. This is not reckless. It is the calculated trade-off required for building wealth quickly from a small capital base. Let me close by addressing the question of why more people do not do this. If special situations investing can generate 50% returns, why is not everyone doing it? The answer comes down to several factors. First, effort. This strategy requires significant ongoing effort. You need to screen for opportunities. You need to research situations thoroughly. You need to monitor your investments. Most people are not willing to put in this effort. They want passive investments that they can set and forget. Second, psychological difficulty. Buying when others are selling is emotionally challenging. Holding through volatility requires conviction. Concentrating capital requires courage. Most people are more comfortable following the crowd, even when the crowd is wrong. Third, short-term focus. Modern financial media focuses on daily price movements and quarterly earnings. This conditions people to think short-term. Special situations investing requires thinking in terms of years, not days. Most people struggle with this time horizon. Fourth, institutional constraints. Professional money managers face constraints that prevent them from pursuing this strategy. They have asset allocation requirements. They have liquidity needs. They have career risk if they underperform benchmarks in the short term. These constraints push professionals toward index-hugging strategies that cannot generate exceptional returns. But as an individual investor with $100,000, you face none of these constraints. You can concentrate. You can be patient. You can invest in small opportunities. You can ignore benchmarks. You have an enormous advantage over professional investors if you are willing to use it. The opportunity is real. The path is clear. $100,000 can become $50,000 of annual income within 5 to 7 years through disciplined special situations investing. This is not a guarantee. There are no guarantees in investing, but the probability of success is high if you do the work, maintain discipline, and give compounding time to work. I have seen this strategy work for myself. I have seen it work for others who are willing to put in the effort, and I am confident it can work for you. The question is not whether this is possible. The question is whether you are willing to commit to the process, whether you are willing to do the research, develop the skills, maintain the discipline, and exercise the patience required. If you are, the rewards are extraordinary. Financial independence, freedom from financial worry, the ability to live life on your terms. This is what $100,000 can become if you treat it not as spending money, but as seed capital for building lasting wealth. Start today. Start building your knowledge. Start screening for opportunities. Start developing the skills and mindset required. Your future self will thank you for the decision you make right now.